Welcome back to the Investment Academy. In today's episode, we are going to demystify some essential tools that investors use to pick stocks, the fundamental analysis, and some key financial metrics. This can be very useful for you if you wish to learn about stock analysis and enhance your stock picking skills. So let's dive in. When it comes to analysis of stocks, there are two primary schools of analysis, namely fundamental and technical analysis. Fundamental analysis involves evaluating a company's financial health and business environment to determine its stock's intrinsic value. Technical analysis, on the other hand, focuses on patterns in stock prices movement to predict future activity. In fundamental analysis, we look at revenue, earnings, future growth, return on equity, and many more factors to assess a company's value. You can find these details about the company on various websites, but the one that I personally prefer is Screener. You can visit the screener.in to check the fundamentals of any company. Fundamental analysis is a broad concept and requires a lot of effort, but if you do it right, you will be making better investment decisions. I will try to explain how to do a fundamental analysis of stocks from scratch. Firstly, there are two methods of doing this, called top-down and bottom-up analysis. In top-down analysis, first, we look at the macroeconomic factors like inflation, GDP, and overall market sentiment of the country. What are the plans? Where does it plan to spend? This takes us to the next step, which is industry analysis. You need to find out which industry is on the rise and which one are on the downward slope. You need to make sure that the conditions of the industry you are choosing is aligned with your investment objectives. Some industries like EV, IT, etc. can be good for the long term because their business has the potential to do well in future and long term. Some industries are cyclical like automobile, banking, etc. which does good for some seasons and stays decent during others. Some are defensive sectors like pharmaceuticals and consumer products. They are called defensive because the need for pharmaceuticals and consumer product is least likely to decline, and hence these businesses are consistent and more resistant to economic downturns. Once you are certain that stocks from which industry you wish to add in your portfolio, next step is to identify businesses that are on the rise in that particular sector. You need to check whether the business model or the idea of the business is good or not. How is that business going to perform against its competitor in that industry? What is the unique selling point that can make them successful? And what are their objectives in the future? This will help you shortlist a few companies that will have the potential to enhance your wealth over time. For the selected companies, you need to have a look at the management of the companies. The top management and the CEO play an integral role in the future aspect of a business. You can search for the owners of the company over the internet and ensure that the CEO or senior management is not involved in fraud, and also what proportion of shares he or she is holding in that company. Fewer percentage holding denotes that the promoter does not believe in their business, while too much concentrated promoter holding signals that the promoter can make decisions for his own benefit in the company. Once you are confident about the management, you can check the fundamental ratios of the company. Now, there is a plethora of ratios that professional financial analysts and fund managers use to identify good stocks. But as for retail investors, two important ratios must be considered while analyzing the stocks. The price to earning (PE) ratio is calculated by dividing the current market price of the stock by its earning per share or EPS. This ratio indicates how much an investor is willing to pay for 1 rupee of earning. PE ratio of 10 means that the investors need to pay rupees 10 to earn 1 rupees. PE ratio of a company can be compared with the peers and the industry average to find out the best valued companies. Another important ratio is PB or price to book ratio. If you remember, in the very first video of this series, we discussed that the market value of the company is calculated by the number of shares multiplied with the value of one share to get the market value. The book value is total value of assets minus total liability of the company, which is also considered as intrinsic value of the company, while the market value is driven by demand. The ratio of market value to the book value of the company is called PB ratio. PE ratio and PB ratio are lesser the better, but it needs to be compared with the industry average and peers. At times, it can also be compared to its historical value. Apart from this, there are many other ratios like ROE, ROCE, debt to equity, dividend yield, etc. But we will be learning about them in the advanced concepts. Next, we will move towards the last part of fundamental analysis, which is analysis of the financials. For this, you can visit screener.in to check the sales, operating profit, EPS, net profit, assets, liabilities, and cash flow. The constant increase in sales denote that the company is heading in the right direction. The same goes for net profit. If the net profit is not increasing, you can also find out why. If they are making investments for the future of the company, then it is a positive sign. Analysis of net cash flow becomes very important, as even if the company is making a profit, some companies may not have a positive cash flow as their revenue won't be in cash. Once you are comfortable with the financials and find that the company is better than the peers in that industry, you can invest in that. That was the top-down fundamental analysis, which can be very useful for retail investors if done in a right manner. The bottom-up strategy involves the same steps, but the order is opposite, as it starts from the analysis of the fundamentals of the company. The bottom-up strategy can be more time-consuming, as you'll have to analyze the financials and ratios of a lot of company, which can be very time-consuming. That's why I personally prefer the top-down strategy for retail investors. So that was all about fundamental analysis for the beginners. I tried to cover as much as I can in short. In our next video, we will be learning about the technical analysis, which is completely different from the fundamental analysis. Until then, keep learning, keep growing, and keep smiling. Investments in securities market are subject to market risk. Read all the related documents carefully before investing.